accounting is done with models, okay? And these models, there's a particular way to learn with the models. So there's really no difference between management accounting and strategic case study. Okay. Now, every model or every topic, let's say the models are topics, right? Every model that you see, this is how you learn it. Let's say you are doing ABC, know the concept or the principle behind ABC. What is it about? Are you following? Write this down. This is how we learn man accounting. Two, ask yourself, how similar is this to other models or how different is it from other models? Make sense? Are you following? The third thing to do it is if there are any calculations, how do I deal with it? Are you listening? If there are any calculations, how do I what? Deal with it. And what are the formulas? Are we okay? Then finally, what are the advantages or the pros? And what are the disadvantages or the cons pertaining to that particular what? Model. Are you following? Now, do you know where most students get stuck? They get stuck here. They are only stuck on the calculations. You are expecting ABC to come as computation. And then you top principle now. True or false?
True.
Oh, expect to say, oh, ABC theory by this time, why you ready? No. To target costing, which is still similar to ABC. And OAR, meboa. Now, foul. Next time you prepare your call, which calculations need be call. They didn't ask you anything. They just ask you advantages and disadvantages of ABC. Say, hey, we cry. How do we predict them? They've changed the trend. I see in Sisa trend BI. You are not learning the right way. Hello.
Hi.
So have you gotten the secret now? It's a model be our funnel. Okay, what is it about? What is ABC about? Okay, what is the similarity between ABC and traditional costing? How is ABC different from traditional costing? Are there other costing techniques that we can apply the same way? That is it. That's where you are. The next thing, okay, so how do I do calculation for ABC? What are the advantages and disadvantages of using ABC? Value chain. What is value chain? How similar or different is value chain from other models of performance? Can I do calculation for value chain? Roughly no, right? But what are the advantages and disadvantages of using the value chain? Tell me the truth. Everybody, give me your honest opinion. If you learn like this, are you going to fail?
No, you will not.
I want everybody to give me your opinion.
To say last sitting, yes, yeah, budget.
It's true.
Rating.
You see, you are learning the wrong way. Me, I like to tell people the bitter truth. The courses are not difficult. Who am I? I never failed an ICA paper. I became the youngest chartered accountant when I was 18. I wrote 4 papers in level 1, 6 papers in level 2, wrote 4 papers in level 3. I had awards, about 2 awards. The first one, I had 99% in level 1, and I only started level 1 in 2 months. Level 2, I was very ill. I wrote 6 papers. Management accounting, I wrote it under 1 hour, 40 minutes. I had 75. I knew I could get 100 because I know how to learn. Okay? So,
Hey, sir,
They are good.
were you by then working or were just
yes,
at
I
home
was.
learning?
I was working.
Because I still the office.
I was working.
Oh.
I know the strategies. All right. I know how to crack this thing. It's a game. If you don't know the rules, you beat about the bush. You walk. You will walk. I wrote management accounting in under 1 hour, 40 minutes. I was very ill. I had 75. So translate. If I did the whole 3 hours, I can get 100. Because I was very ill. So since then, I've been teaching management accounting since. I mean, the thing is, the papers are my operating table, and I'm the surgeon. So if you have any problem, you come and we solve, right? So this is the first code. That is to tell you that you are in good hands. So first, I needed to tell you that to give you assurance that you're in good hands, right? The next one is, well, we've already committed whatever we have into the hands of God. That's the first one. God will handle the impossible. Let us do the possible. So the possible starts with the concept, okay? Understanding the concept, how similar or different, if there are any calculations, then the pros and cons. Please, have you written them down? This is the cheat code to any model. Please, have you written the cheat code down?
Yes, sir.
Yeah.
Yes. So with this alone, I can guarantee you your pass mark. Now, the next thing I want you to do is, I want you to unlearn anything you have learned. What did I say?
And learn anything you have learned.
When I say unlearn anything you have learned, some people learn a lot of chaff. I won't lie to you.
That one there.
The method even you are supposed to use for variance that will make you understand, people are not using it. See, do you know that your brain only remembers things which are similar or which it can relate to? But if for every variance that you calculate, you use a different formula, how will you remember? You see where we are getting it wrong? So, everything you know about the way you compute variance, there are so many ways. I want you to throw it away. Capiche?
Yes, sir.
Okay. Nice. So what then is a variance? I'm starting from class 1. Though I'm not supposed to. We are supposed to solve questions. Yaka variance now, a patron said the variance. Variance comes from the word what? Variation. Makes sense. Variation comes from the word what? Difference. Difference comes from the word what? Not similar. Not similar comes from the word what? It goes on and on. All right. So we are saying that a difference or a variation in something against another thing is what we call a variance. It's just broadful. Good. Now, the reason why you have to know variances is because you want to measure performance. How? You will set some target for some people to achieve. Are you following? Then you need to check whether the target was actually what? Achieved against what? What they actually did. Are you listening? So the target that you set is what we call the standard. What did I say?
Standard. Target
And what
standard.
actually happens is what we call the actual. So a variance is a difference between what? A difference between what?
Standard and actual.
Standard
and actual. There's no other definition of variance again that I want you to trust. And this thing is what forms the formulas you have been learning. But we just look at the formula. We don't understand the reason why it is between standard and actual. What is standard? Standard is the budget per unit. What did I say?
Standard is the budget
per unit.
Yeah, so the budgeted cost per unit is what we call standard. So anytime we say standard cost, we mean that we took some fixed budget, okay, and then we divided by the level of activity. Are you getting? When I say level of activity, you understand? Or let's say the, how do we call it? The budgeted level of activity. So budgeted cost per unit is actually an OAR. That is your standard cost. So anytime you see standard cost, it means OAR. So there's a budgeted, a fixed budget with a budgeted what? Level of activity, okay? And level of activity can simply be how you are measuring, okay? So it could be based on labor hours, which is a common measure by ICA. It could be by machine hours. It could be by level of activity. It could be by anything, right? Like units, number of staff, batches. It could be anything, right? But what I'm saying here is that when we say standard cost, it is your budget that has been reduced to a per unit term. Does it make sense?
Mhm.
Is it clear? If you don't get this concept, you always have a problem with management accounting. The problems people have with management accounting is where you have 2 CD per hour, and you have to multiply by the number of hours. Sometimes it confuses. True or false? I've been there. I know. That means you don't understand the concept of standard cost. Once you click it, something will click in your brain. You can solve every question. Let's understand this. So I said standard cost is what? The budget in what? Per unit what?
Per unit terms.
Per unit term. So anytime you take your budget, your budgeted cost of, let's say, 500,000, are you getting it? And you divide by what? Let's say 50,000 labor hours. That gives us the standard cost of labor, which becomes what? 10 CD per what?
Per unit.
Per labor.
Per hour.
So the
Labor.
10 CD per labor hour, no near friend, is standard rate for labor. It is a standard cost. It is the same as your OAR, overhead absorption rate for labor. But here's labor cost. I'm just explaining, okay? So what we are saying is that the concepts you are learning, they are all the same. You are always getting some cost per unit, cost per level of activity, right? And then we are saying the budget, I get it, when it is reduced to per unit terms, it becomes what? Your standard. Makes sense. And we said variance is the difference between what?
Standard and the actual.
Standard and actual. It means that any variance, let's come home, right? In your organization, various managers perform various roles, okay? Let's start from the top. What is the role of the procurement manager? What does he do? What does the procurement manager do? What does it do?
He procure materials for production or for service
So
deliveries.
either raw materials, I get in for what? Production, maybe, or what happens? He procures finished goods for resale, maybe, which becomes our purchase. No be so. That we resell as sales. No be so. Good. So the procurement manager does these two things. But remember that whatever he is buying, he's supposed to negotiate better prices. True or false?
True.
True.
The procurement manager has to negotiate better prices because they change. And he also has to get good quantities. True or false?
True.
Yes. But it could be that at the end of the day, the prices may not be good, but he could have gotten what? Good quantities, right? Maybe 5,000 bags, but he was able to negotiate to get 6,000 bags. Or we wanted to sell it at what? Wanted to buy it at 2 CD per kg, but this procurement manager was able to get it for us at what? 1 CD per kg. Do you understand? So it means that anytime something happens, how do we get value? Value is made up of what? Quantity times what? Quantity by what?
Price per unit.
By price. So it means that anytime you're talking about a variation, there could be a variation in quantity or there can be a variation in price. True or false? Because
True.
this man wanted 5,000 units, but he got 6,000. That means there was a variation or variance in the quantity. Meboa. The same way, we wanted to buy it at what? 2 CD, but he bought it at 1 CD. There was a variation in the price. No be so. True or false?
True.
True.
That means variances can actually be in quantity or they can be in price. Makes sense? And this procurement manager, assuming Nanom Bonyum, now is supposed to buy it at 1 CD per unit, and he ends up buying it at two CDs. Has it been effective?
No.
That means that this price variance, who controls it? Raw material price variance is the procurement manager is in charge. Variances are the same as ratios, okay? But people don't know. The way you interpret ratios, you interpret variances the same way and criticize the managers involved. What about material usage? Which manager will be involved? Which manager uses the materials we buy?
Production manager.
Production manager. So if you have an adverse material usage variance, which manager is to be blamed?
Production manager.
So If I have a favorable material manager, material variance, has the production manager done well? Yes, he has.
Yes.
So you
Yes.
explain this might be due to. That's how you see the same way you do ratios. Let's say this one I want to interpret, right? So I say what? Performance of the procurement what? Manager. I see it doesn't tell you, but you have to interpret the variances you calculate. They attach marks to it. Don't tell anyone. It's a secret. So what happens is that you say what? The material what? Material price what? Variance. The procurement manager, right? The procurement manager has had detrimental what? Performance, right? Due to what? It's brothel. Like has had detrimental performance due to what? An unfavorable what? An unfavorable raw material price variance. Are you getting it? Of what? Of one
Yes.
CD adverse, right? Indicating that he didn't what? He didn't buy on good terms or something, right? Then you say this might be due to. Why do you think he might have bought it at a higher price than expected? One, wrong budgeting. He didn't budget well, right? Poor relationship with suppliers. True or false? Does it make sense? If I have good
Yeah.
relationship, I can buy low. What else? Economic conditions, like fuel prices, the pestle factors that political, legal, economic, those things all can play a role. But always wrong budgeting is the first one you have to talk about. So you see the things that you are learning, yes, they are actually good for performance appraisal or analyzing, right? But the thing is, the reason why I'm spending time to let you understand this is so that the 15 marks there, you get 15 over 15. That's my target for you. Because that's 65. We are going to prep so hard that when you go in there, there's no way anything will beat you when it comes to that 65. The rest, budgeting, I'll still teach you budgeting and the techniques, all that, the various ways. There are 3 ways we do cash budget, but people know only one. It's funny. But I see always test either of the 3. So you can do cash budget from ratios, you can do it from control accounts, and you can do it from the normal estimation. How many of you know this?
Yeah.
This is the first time.
But
We
people,
don't.
don't know that cash budget can be done these 3 ways. That's why I say it's a time waster. So you go in, you don't know which one they are asking. How would you know? You have to test the data. And I see I've seen that most students do not know NFPIs, right? Non-financial performance indicators. So they mix it with the financial performance indicators. They mix it with public sector and bring it. Like last night, you see, the long case they brought in question 1.
Yeah.
Mixes everything up. Yes, it's because you are used to short questions. That's why. Okay, so your paper that you are doing before NENIDA or now they've mixed ACCA F5 and ACCA P5. They have mixed the 2 papers together as one, which is your management accounting. But before, your paper was ACCA F2 and F5. Now they've taken the F2 out, which is what they've put in level 1, and now they are testing F5 and P5. Even P5, they've taken the uncertainty and some things, decision trees, linear programming. So you guys will be fine. You'll be fine. Any questions so far?
Hello, sir.
Yes, somebody say hello, sir. Yeah.
Yeah, so I was trying to find out that
Mhm.
in every variance you calculate, does it mean you have to give the interpretation just as you did?
Depends on the marks.
Okay.
Yeah. So if it's a full 50 marker to 20, yeah, you can give a small interpretation down there. Are you okay? Now, since I told you every variation can be caused by what? Can be caused by what? A change
Price
in
and quantity.
quantity.
Quantity or a price?
Yes, it can be changed by, it could be a change in quantity, or it can be a change in what?
Price.
Change in price. Every element of cost and revenue has that change, right? So if it comes to your revenue variance or your sales variances, okay, the quantity variance for sales is called the sales volume variance. Are we okay? Are we okay? And
Yes,
then the
sir.
price variance for sale is called the sales price variance. Because imagine, I decided to sell goods at 2 cedis per unit, right? And I wanted to sell 5,000 units. No, so that means I was expecting to sell 10,000. But the sales staff that I brought in, she was very good. She was able to increase the price to 10 cedis per unit, and she was only able to sell what? 4,000 units. Do you understand? So at the end of the day, what happened? She got 40,000, which means this girl has done very well as a sales staff. True or false? But at the end of the day, if we look at the price variance, did she do well? In terms of price, did she do well? In terms of price,
Yes.
Yes,
in terms of quantity,
yes.
in terms of quantity,
He didn't do well.
no. You understand? Aha. So you see, there's a variation either in price or in quantity. So it's either you have what? A sales volume variance, or you have what? A sales price variance. This one can be sub broken down, right? Even your volume, when you sell more than 2 items, okay, when you sell more than 2 items, it means that you can mix. Let's say I sell different brands of toothpaste, okay? So let's say I sell Close Up and I sell what? Pepsodent, right? In each sale that I make, I can sell 2 Close-Ups and 1 toothpaste, right? True or false? And then this Close-Up and Pepsodent that I mix, there's a particular yield that is coming out of it, right? Or there's a particular quantity that I'm getting each time I mix this, right? That means if I mix 2 of this and 1, in the whole box, there's, let's say this one has 24 in the box, but this one has maybe 16 in the box. That means the quantity that will come out will be different than what I expected each time. Does it make sense? So I decided to mix 2 of Close Up and 1 of Pepsodent each time I sold on the market. But at the end of the day, you will realize that because of the demand, I ended up selling 1 Close Up and 3 Pepsodent because people like Pepsodent more than Close Up. So has my mix not changed?
It
Yes,
has.
Chair.
That is what we call the sales mix variance. So it's not just calculation that we do, it has meaning. Did it make sense?
Yeah.
So the sales volume can be broken into sales what? Sales mix and sales quantity variance. This is like sales yield, like what actually came out from mixing those ones. Okay, so the quantity variance has the basic variance, which is just the gross volume, and it has advanced variances, which is the mix and the yield. Very simple. Then we have the price, right? Okay, now we are done with sales, which is the ogboro. Now let's go to the cost element. So each cost element also has a value, right? It has a price per unit, and it also has what? A quantity. So if we take material, okay, raw material, materials also have quantity. The quantity variance for material is what we use to work or what we use to produce. So we call it the material usage what? Variance. No be so. But material to who buys? The procurement manager must buy at a certain price. So we call it the material what?
Price variance.
Material price variance. Thank you. Okay, so material price variance, right? So material usage variance. a material price variance. So this is for material. But then, because raw materials too, we don't use only one raw material to produce. True or false? Do we use only one raw material to produce?
No.
We
No.
can mix different raw materials, and the mixture of different raw materials will bring different tastes. True or false?
True.
So let's say that we wanted to make Milo today, right? We are hungry from work. Then we say, Charlie, I get something of milk be power for fridge. Oh, I get some Milo B for fridge. Okay, so let's say that, okay, I want to mix what? 90% tin of milk with 5% Milo and 5% water. This makes 100%. Otherwise, when I pour more water, the tea will overflow. True or false? Because the whole cup is 100%. You should fill the cup. Now I came home. Then I realized, so beyond milk, I realized that somebody has what? Drank my milk. And the milk is left with 60%. Also, so what happened? I had to fill in what? 10% of what? Milo, and then fill in what? 30% of water. Has my mix changed?
Yes.
Yes.
But which one has the most sweetest taste?
The first one.
The first one is creamy, right?
Mm.
This creamy is what we call the yield, the taste that came out as a result of mixing this Milo. But this one, will it come out creamy or it will come out water?
Okay.
Watery.
Right? So this one, we said that the yield will be different from the yield that came from this mix. Do you understand? So you using the raw materials will mean you mix them in a particular way to come out with a different or a particular taste. Makes sense? So that is what we call the material mix variance. And then what? The material yield variance. That means without a mix, you cannot get a yield. Without a mix, you cannot get a quantity. Hello?
Hi.
Is it making sense?
Yes, sir.
They are not just formulas. Are you getting the basics? So we are
Yes,
saying
sir.
that usage, what you use, if you have more than one material, always check the question. If there's more than one material, it means definitely there's a possibility of mix and yield. That is it. All right. So we go to what next? What follows? What follows?
Material price.
Price.
Oh, material price, I've already written it. Price, usually there's no breakdown. Price is price, right? Okay, so labor. Let's come to labor. Do you know that when it comes to labor too, we have labor what? Labor doesn't use, we don't, when we use labor, is the labor hour, right? So we have the labor hour variance. But if you use more hours than expected or less hours than expected, we call it efficiency. Are you following? So with the efficiency variance too, are you getting? That's the quantity variance for labor. But then labor doesn't have a price. Labor has what? We pay labor what? Do we pay labor a price or we pay them a rate?
Rate.
So the price variance for labor is called the rate variance. Okay? These are the two. But efficiency can be further broken down. Why? Do you know that in a particular organization, there are skilled labor and there are unskilled labor? True or false?
True.
Or there could be grade 1 labor and grade 2 labor. True or false? So every organization must mix a particular kind of labor. Are you getting it? To get a particular output. True or false? That means if I want to produce a book, okay, I want to produce a book. If I combine 2 skilled labor with 1 unskilled labor, that usually takes me about 15 days to come up with a book. But if I combine what? 4 skilled labor and 1 unskilled labor, or maybe 2 unskilled labor, I can finish this book in just 4 days. What happened? This was what? This one is it mix or yield?
Mix.
And what happened? This is what?
Yield.
Outcome,
15.
yield. Mixing 4 skilled labor and 2 unskilled labor was the mix, and this is the outcome. which is the output, which is the yield. Makes sense. People didn't know labor had mix and yield. Yes, labor does have mix and yield. Hello. Are we learning something?
Leo.
So mostly the problem is the basics. It's the basics that is causing these problems. All right, so now we know labor. Let's come to overheads. Now, overhead at ICA level, ICA never uses machine hours, okay? They always want to stay clear. So with overheads, let's start with variable overhead. Do you know that if I'm working at my office, right? The time I stay and work is the same time my fan will be on, true or false? It's the same time my PC, my rent and everything will be running. Meboa.
Yeah.
So if I leave, will those things still be running?
No.
Unless I have a machine which runs with different hours, right? So usually ICA assumes that all overheads in variance depend on labor hours. What did I say?
All overheads depend on labor hours.
Yes, because they depend on labor hours, it means that the overhead hours that they use are the same as the labor hours. Do you understand? Because if I use 2 hours to work and my fan, which comes with electricity, is on for 2 hours, is it not the same hours?
Yes.
Yeah, so it uses the same labor hours. So a question will be silent. And then you are looking for variable overhead hours. Saying, Master, don't try. Variable overhead hours, then one labor hour, no. Because time out here, the same time that those overheads will be running. If you go home, then they won't be running. Makes sense. Makes sense.
Yeah.
So variable overheads to have a rate, and the rate that they have is what we call the OAR. Okay, but instead of calling, however, if you call it variable overhead rate variance, you are not wrong. But because they are expenses, we just call them expenditure variance. Make sense? Make sense?
Yes, sir.
This table, are you writing it or you understand so we can move?
Oh, we
Yeah,
are
right.
writing.
Really?
Sure.
All right. So let's come to what we call the fixed overhead variance. Now let's look at something here. This is where it gets a little crazy. T, do you know that if I am using overheads, like fixed overheads, like rent, okay, something we call period costs, okay? Mostly we absorb. In management accounting, don't we absorb?
We
We
do.
do.
But it can mean that when we're absorbing, we ended up using more hours than expected. True or false?
True.
And it could be that our production capacity that we're using, the absorption that we did, was at a different level compared to what our existing capacity. True or false? So using more or less hours than expected is our efficiency. And using more than your capacity or less than your capacity results in what we call a capacity variance. So based on your capacity to absorb and your efficiency, they give you the volume of fixed overheads you have actually used. So in that case, your fixed overhead quantity variance is called volume, okay? But this volume can be broken down into what? Capacity and what? Capacity and what? Efficiency. Okay? So volume is equal to what?
Capacity.
Capacity and efficiency.
Efficiency. Okay? Now, this is where the labor ratios come from because we are using the same labor hours. Let me explain. Volume equals to capacity plus what? Plus efficiency. True or false? Here,
True.
we are adding because we are finding variances. Variances are in monetary terms, right? But if we want this in relative terms, when we say relative terms, we mean in percentage terms. You remember that when you are doing ratios, we either divide or we what? We multiply. No be so. But if we want money, we add or we what? We deduct. True or false?
Yeah.
Okay, let me ask you something here. Addition, what's this corresponding in terms of multiplication and division? Which one can I link it to? Addition is equal to what? Is it multiplication or division?
Multiplication.
Yes, addition adds more. Then division is like subtraction. Mebwa.
Yeah.
Yes.
So we are saying that in terms of ratio, when I want labor ratios, it means that production volume, wherever I see addition, just like here, I multiply. Production volume will be equal to capacity times what? Times efficiency. Makes sense. So it means that our production volume should be equal to what? Our capacity ratio times our efficiency ratio. So it's just the fixed overhead ratios. Nah, that's what gives us our labor ratios or our control ratios, which we are likely to get this diet. Okay, it's that easy. So fixed overhead still uses expenditure because fixed overhead, we must pay them a standard rate, which is the OAR. Okay. But here, because they are expenses, we call them fixed overhead expenditure. So have we really understood the whole variance game? What quantity variances we have and what price variances we have for each particular element, cost or revenue element. Are we okay? It's question time. Oh. It's question time. That means will be any question. Wow. Then you guys are smart too. Okay. Good. Now, let's come here. I told you variance is a difference between what?
Standard and actual.
Variance is a difference between what?
The
Standard.
actual budget
And what? Actual, right? So it means that
Yes.
any variance that you will see, it is either going to be standard minus actual or actual minus standard. Okay, and this is how you come up with the formulas. Variance formula, and you don't have to mow it. You mow and say a trim. That's what you get wrong. It's because you don't understand the concept. Variance formula because you don't understand it. Are you starting to get the whole game?
Yeah. I said, you see, sometimes it's not our making, the hands that you passes through is also a key factor.
Really?
Yes.
Mm-hmm.
The hand can make you or make you. And that affect your understanding capacity.
Okay, that is also true. But most of the thing, whether you are learning at home or you are going to class, you have to put in the effort, right? Though it counts, but what if the person didn't do it and you still want to achieve? You have to push. Okay, now there's so much information available. Okay, but my only problem is that sometimes too many students get information overload. They pile too many things on themselves, but you could have started earlier. Do you get it? That's one problem. And also, man accounting, if you pile so much information, you can fail. Do you know why? Because we'll be a method. Do you get it? That's why when we started, I told you to unlearn everything you have learned already. Because I go with the latest and the shortest roll forward method. For me, my student is not supposed to struggle in exam, no matter the course I'm teaching you. You have to sail smoothly. Do you understand? So, because every question will be based on this, either a standard or an actual, it tells me something. That every variance that you get is either a standard subtracting an actual or an actual subtracting what? A standard. Do you get it? So, remember that I told you standard cost per unit is what? How do we get standard cost per unit?
Material multiplying the price.
No, per unit. Oh.
Budgeted.
Budgeted over.
Yeah, I
Budgeted.
understand what you are saying, but standard cost per unit, we said something. We said we have to get a total budgeted cost or revenue, right? And divide by what?
Level of
Level of
budgeted.
Budgeted level of activity. Mebwa. Do you remember? To get our budgeted
Yes.
level of activity. Okay, I'm coming. Oh, why is this thing behaving like that? Today I want you to learn this concept. Once you get this concept for me, where we so budgeted level of activity, and I told you this level of activity can be what?
Labor hour.
Labor hours, machine hours, whatever, right? You are just dividing. You are trying to find the cost per unit. Now listen carefully here. This is where it gets important. You see this one, I told you standard cost per what? Per unit. You see this one, if I want budgeted cost, what do I do? If I want budgeted cost and I'm giving standard cost, it's the same thing, right? If I want this one back and I'm giving this one, I have to multiply by this. True or false?
True.
That means I must take my standard cost per unit, no be so, and multiply by the budget units. True or false?
True.
Okay. But what if now I want the total standard cost? Okay. The total standard, you see this one is standard cost per unit. What if I want the total standard cost? Standard cost is always of actual level of activity. What did I say? Not standard cost per unit too. Not standard cost per unit. I mean standard cost in total will always be at the actual unit produced. Okay. So that means our standard cost per unit, if I multiply by actual units produced, right? I get the standard, the total standard. So that means standard cost per unit can either create what? A budgeted cost, or it can create a standard cost. This is what you call flex, standard flex budget. So standard cost per unit, they say he can either create a budgeted cost, or he can create what? A total standard cost. And another name for total standard cost is what we call flexed. So we use it in a flexed budget. Interesting. Does it make sense? So let's take a flex budget. I believe last night a flex budget came, right? Or last 2 nights. I don't know. It's been a while since I taught Emmy. Which night did flex budget come? Why is there silence in the class? Please talk. Oh. Did you get the concept I put across?
Yeah.
What did I say? Somebody should repeat it for me. What did I say? Somebody should repeat it for me. What does standard cost per unit create?
Standard cost per unit creates two costs. That's the budgeted cost and the total standard cost.
Yes, which is also known as the flexed. So when we say flex, it means that we want you to reflect something at the actual units produced. Does it make sense? Does it make sense? If it doesn't, oh, say we don't get it. That's why I'm here for you. Does it make sense?
Yeah.
So what am I saying? Let's see something. Right now, let's say 2 friends have met. Oh, Kojo, what's up? Oh, Charlie Adeo, how far? Hey, where do you even work? Oh, what do you do? Oh, I'm an accountant, but I work with MTN. Okay, so how much do you get paid? Oh, I take 10,000. Oh, Charlie, my work good pass you. Me, I'm a marketer. I work with Vodafone. I earn 12,000. We can't compare the two. Do you know why? Who can tell me why we can't compare these 2 friends and their salaries, whether one is doing well than the other?
Their
They
job
are
portfolio.
not related.
1, their jobs are unrelated, and 2 different organizations. True or false?
True.
We can only compare if we also get a marketer from MTN. True or false? And compare. Or
True.
we also get an accountant from Vodafone and compare.
Yeah.
So it means that anytime you want to compare 2 things, there must be a similarity between the 2. What did I say?
Anytime you want to compare 2 items, there must be a similarity
between the 2. Why? What is that similarity? Remember that I told you a variance can be what? A variance in what?
Quantity or price.
Yes. A variance in quantity or price. So if a variance can be a variance in quantity or price, it means that if I'm comparing two things, then it's either the quantities will be the same and the prices will differ, or the prices will differ and the quantities will be the prices will be the same and the quantities will differ. Does it make sense? Is something sinking in? What did I say?
Yes, sir.
I said anytime you are comparing two things, because you are comparing quantity and price, it is either what?
The quantities are the same and prices will differ.
Or
Or prices are the same and quantity will differ.
that's all. Have this rule and you will be fine. And one year, in the variance, and the reason why you have standard price minus actual price all times actual quantity is because the quantity now is the same, but what the prices differ. Why do we have standard quantity minus actual quantity all at the standard price? You see, all at standard price, meaning standard price was the common factor, but the quantities were different. Did it make sense? And always use that MTN Vodafone example I gave you. Does it make sense?
Yeah.
Yes. So there must be some level of comparative, some level of comparison that we can make, okay, to really understand what is going on. Hello. Okay, so we'll go to ICA May 2015. It's a rare question. Hardly do people get it, but let's go to May 2015 and let's go and solve the flex budget for you to understand this very well. After that, we'll learn how to reconcile profits. We'll come back to November 2015 and come and deal with question 3. All right. I hope whatever I'm telling you is sinking in, or it's not sinking in.
Sinking.
If it is not, you tell me. Oh, yeah, sure, dear. May 2015 adapted. So mostly there's a budget that makes sense. What did I say? There's a budget that makes what?
Sense.
That makes sense. You see your fixed budget because of changing external environment, because of political factors, the dollar depreciating against the CD, all those things happening in the system. You don't expect that 1,000 units here that I budgeted some years ago, I am still going to use that same 1,000 units to plan. You know, it can change. True or false? It can change, right? So when you are planning, it is better that you reflect everything at the actual units, right? Does it make sense? Because that one has actually happened. So now we have a better guess about what has actually happened, and we can use this to take a decision. So a budget for control purpose is what we call a flexed budget. What did we say?
Budget for
Budget
control.
purpose.
So sometimes you can go to the exam and ICA will tell you that prepare a budget for control purpose. So preparing a budget for control purpose means that they want you to prepare what? A flexed budget. What's the difference between a flexible budget and a flex budget? People think they are the same. No, they are not. But sir, they have the same name. Flexible and flex, are they the same?
No.
A flex budget is a budget that is adjusted to reflect actual levels of activity. What did I say? A budget adjusted to reflect actual levels of activity. What is a flex budget?
The
A budget adjusted to reflect the actual level of activity.
A budget adjusted to reflect the actual levels of activity, right? The actual level of activity. Okay, that's a flex budget. But a flexible budget is a budget, are you getting it? At different levels of activity. Okay, which means that a flexed budget is an example of flexible budget. Because this one, there are different levels of activity. So it means that whether it's actual or budgeted, different, that's flexible budget. But flex is at actual levels of activity. Does that make sense? So it means that flex budget is a type of flexible budget. Is it clear?
Yes, sir.
Okay, so we are going to use that concept to do this question. This question came in May 2015. So the budgeted and actual results of Monster Company Limited for September 2015 were as follows. The company uses marginal costing system. There were no opening and closing inventories. Thank you. So this is what we have. Are you getting it? Now you see that this is the fixed budget. True or false? And killing management accounting, there's an odogu we always need to go and find. What is the name of this Baba? I told you he can create two things. What is his name? There's a particular cost who is the god of budgeting. What's the name of that cost? He can create two things. What's the cost I taught you that can create two things?
Standard cost.
Standard cost per unit. If you're able to get this guy, your problem is solved. So now we have fixed budget here, Meboa. And I told you standard cost is got by taking your fixed budget and dividing by what?
Budgeted level of activity.
And dividing by the budgeted what? Level of what? Activity. If you're able to do this, you can get your standard cost per unit. And this is where the magic happens. You can now start multiplying by what? Your actual level of activity to always come and get what? The flexed, which is the same as the total standard. Do you get it? Because the standard I told you is always at what? The standard is always at what?
Actual.
Actual level of activity. That's why if you are doing variance, if you want to get standard price, a standard quantity, you see that when you take the standard quantity per unit, are you getting it? Let's say 2 kg, you always multiply by actual production. True or false? True or false?
True.
This is the reason behind that. Because you want to get the total standard. Clear?
Yes.
All right. So now let's see what we can do. Now we are going to create a whole new budget because this is this is a marketer and this is an accountant, right? But this one works in MTN, this one works in Vodafone. You see, we cannot compare any because they are in two different organizations with different rules. True or false?
True.
True or false?
True.
So what do we need to do? We need to either convert what? We need to convert what? And say, okay, what about an accountant who is also in a marketer who is also in MTN? Remember, so that they can be comparable. So because here, look at it, the units are different, the prices are also different. I get it. Because I said flex budget, we need to compare the unit, right? It means that we must also create what 700,000 units, 700 units as well, and create these costs again to compare. That would make sense that 700, 700. Now both of us are in MTN. Let's compare the marketing function against what? The finance function and see who is doing well. So we'll reflect all at the same number of units and then we prepare. But the fixed budget, I told you fixed budget is a budget that doesn't make sense because things can change. Inflation, risk, so many things can affect it. So we must reverse all this and re-prepare. All right. And that is where we prepare what? The flex budget or the total standard cost budget. All right, so what we are going to do is we are going to prepare this one, and possibly after we prepare this one, we'll close for today, right? Then tomorrow, you already have the concept. We'll start. I will not start with basic variances. I'll start teaching you mix and yield, sales quantity, sales mix, labor mix and yield. We'll do the advanced variances first. Then we'll come and look at basic variances, all of that. Then we'll learn how to work back. Then we'll come and do control ratios. Then I know that variance, you are okay. Then we look at all the theories, interrelationships, the types of standards, advantages, disadvantages of standard costing, every kind of calculation. Then I'll teach you how to crack the code for variance, no matter how it comes. I gave you a trick that will make you see when to use mix and yield. Who remembers? I told you, how do you know whether mix and yield will be applicable to the question? When there are
two materials.
Two or more materials. And how do you know whether sales mix and sales quantity will be applied to a question? When there are two or more goods you are selling. Makes sense. Because definitely you have to mix them to sell. Hello? Are we getting it?
Yeah.
Yes, sir.
So what is the first thing that we need to do? The most important concept, the OG. The OG of MA. Okay? What did I say? The OG of what?
MA.
The OG of management accounting. That's why it makes students don't like limiting factor, make or buy, relevant cost, all those things, high, low, is because of the OG. This OG concept will take you far if you know it. What is it? It is that variable costs per unit is constant irrespective of level of activity. Let me explain to you. If one, what should I even use? Okay. If one marker, okay, if one marker is 2 cedis, okay, when I produce it, even if I produce 100,000 markers, one marker is still what? If one marker costs us 2 cedis, even if I produce 100,000 units of marker, one marker is still what?
2
2
cedis.
cedis.
2 cedis. How is this applied in a question? So look at this. They tell you that you have this budget. Okay, this is a flexible budget. Let me use that before we come here, right? Budget. And we have January. Let's see. So we have January, we have February, and we have March. This is cost behavior. Don't worry. Let's just see something, right? So let's say we had what rent. Okay, let's say we had rent for January, 100,000. Okay, and let's say the number of units. Let me just give you 100,000 units, 150,000 units, and then let's say 200,000 units. Okay, this is what we have. Okay, so this is the units. So let's bring Ghana city. Please, this is a full question. Write it down. Let's understand this concept I put there first. Did you write the concept down in capital letters? Did you?
Yes.
So let's say rent expense. We had this at what? 500,000. Okay. Then we have what? Let's say electricity. Let's say fixed. That one too is 600,000. Okay. Then we have raw material. Okay, raw material cost. Let's say this was 600,000. Okay. Then we have labor cost, right? Labor cost. I'm coming. $800,000 here. Okay. And then we have variable overheads. Okay. This one was 300,000. Okay. Then we have depreciation, which is 250,000. Okay. So this is what we are saying. We are saying that the company has lost its records because of the heavy rain that fell last week. Okay. And then they want you to construct the budget, right? Reconstruct the budget for the company. This question, assuming it even comes to the exam, people will fail. Reconstruct the budget for each month for the company. This, have you written it?
Yes, sir.
Its records got destroyed, right? So let's redraft their budget that they have for the period, because they have missing records, right? They could filter or they could get some of the information, but the other information is missing. Okay, so this is the information we have been presented, and we have to, do you know we can get the missing figures? We can, using the concept that you saw here. The variable cost per unit is always constant, irrespective of what you produce. Does that make sense? A bro back with 2 CD. So me top 5 or me top 10, we bro back still. What is the price?
2 cedis.
CD. It doesn't change. So if I get the cost per unit, the variable cost per unit for one here, Then since it doesn't change, I can multiply through by each one here, right? And I'll come and get all the missing figures. Does it make sense? And this concept, you must have it at the back of your head. It applies everywhere. CVPO, limiting factor, relevant cost, budget, ABCO, anywhere is the same concept. It's a basic concept. And this is why people fail management accounting. They lack that concept. They don't get it. Understood? Kakra, we getting there?
Yes.
All right. Are you done now? Can we go?
Yes.
Yes, sir.
So the first thing is to filter out which ones are fixed and which ones are variable. So which of these expenses are fixed?
Electricity, depreciation.
Electricity, depreciation will be fixed. Yes, depreciation will be fixed, definitely. But what about rent? Rent, is it not fixed?
Yeah,
Yes,
rent is also fixed.
Yes, rent is fixed. Rent is fixed. Okay, so we know that these ones are fixed, Mebwa. So all the fixed ones, they wouldn't change, irrespective of the level of activity. True or false? So that means February will be what? 500,000. No, be so? March
Yeah.
will be what? 500,000. Okay, electricity. That means February to be 600,000. March to be 600,000. No, be so? Then depreciation. That means February to be what? 200,000. March to be 200,000. Yeah, Feleko. Mebwa. Good. Now, what about raw material? Variable. Mebwa.
I said
Labor.
it's 250.
250, sorry.
The depreciation.
Yeah. Variable over here too is variable. But since these ones are variable, what's the concept? What's the concept?
Variable cost per unit is the same.
Variable cost per unit is always what?
Constant.
It's always constant. So if it is always constant, then let's find the one we already know. Through that, we can get the per unit, and then we walk through, right? So let's first find the material cost per unit. The material cost per unit, right? And that will be what? Which one were we given? The material and the unit. The raw material
February.
were given for February, right? And it was 600 units at 150,000 for the fixed, right? So we can get the cost per unit. So 600,000 divided by what? 150,000 units. That means the material cost per unit is saying. That means material cost per unit is what?
4 per unit. 4.
4 cedis per unit, right? So if it's 4 cedis per unit, it means that then we are saying, say, material be a cost here 4 cedis. So it doesn't matter how much we produce, it will still be 4 cedis. So since it will still be 4 cedis, in January, can just multiply this 4 cedis by how many units were in January? That's about 100,000 units.
Yes.
And that gives us what? 400 what? 1,000. And for February, we can confirm 4 cedis by what? The 150,000 units that were produced. What do we get? 600,000. Is it correct? Yes, we have been able to prove that it is true. Then March, how many units did we produce in March?
200,000.
200,000. So that gives us what?
800.
800,000. Okay. So it is this concept that is killing students. So raw material, we know that it is what? How much here? 400,000. This is 600,000. This is 800,000, right? Gradually, we are filling the void. Are we getting it?
Yeah.
Okay, so we do the same for labor. So because of time, let's work quickly. So labor, which one were we giving? We were giving 800, right? 800. So if I divide by the 200 units, it means labor cost per unit is how much? 4. No, be so? Is it not 4? So we're giving this one. This one, the units were 200.
That's 4.
This and divide by the 200. The one you know is what you do. Okay, so the one you know, this one.
800.
So 4 by 100 is the same thing as this one, right? This one to give us 400,000, 600,000, and 800,000. Then we come to variable overhead. Variable overhead, we're giving 300, and the unit there was 150. So 300 over 150, that's what? 2. No, be so? That means it's 2 per
Yes.
2 per unit, 2 by 100, that's 200,000 also. 2 by 150, that's 300. 2 by 200, that's 400, right? Have we been able to complete our budget?
Yeah.
So what you were doing is what we call a flexible budget. And this is a full question. This is a 10 marker. Okay, so what's our total budget? You guys understand, right? We just add and that's all. We are done. You see how variable costs are very important. Yes. Okay. Any question? Contribution, deduction, addition, anything? Anything? Obi ani hweka. Tienko eni.
Yes.
All right, good. So now let's deal with the ICMA 2015 question and use the same approach. This one, they were giving actual results. So what are we preparing? A flexed what? Budget. But they didn't ask for a flex budget. What did they say? Prepare a budget, that will be what? Prepare a budget, that will be what?
Management control purpose.
Useful for management control purpose. How would you know that it's flex budget? I told you that this budget, it is a budget that makes sense. It's a budget that is reflected at actual units and it is used for control purpose, right? Makes sense. Good. So what's the first thing we have to do? We have to declutter the budget. We have to get our standard cost per unit. Do you remember?
Yeah.
Okay,
Yes, sir.
so we have to declutter the budget. So first, I'll start with what? My variable cost of sales. Okay, I'll start with sales, right? So sales price per unit, everything. Sales price per unit, everything.
$30.
That's 30,000 divided by what?
Yeah,
1,000.
30.
1,000 units.
1,000 units.
And
Yeah.
that gives us 30 CDs per what? Per
Yeah.
unit, right?
Per unit.
Now I want the flexed, which is the standard. Mebwa.
Mhm.
So the standard will be what? That's taking this 30 per unit and multiplying by what? The 700 actual. Mebwa.
Yeah.
I
Yes,
told
sir.
you standard should always be at the actual units produced. And that's how much? 30 by 700?
21,000.
Mhm.
You get it? Okay. So now that you've understood the concept, if I come to a direct material, so direct material, I'll just take what? It was 10,000, right? So I must divide by the 1,000 and I'm going to get what? 10, right? 10 per unit. No be so. Then multiply this by 700, you get what? 7,000. No be so. Good.
Yeah.
Direct labor, 5,000 divided by the 1,000 units. That gives me 5
5.
per unit, but by 700 actual unit, 57. Is it 35? Is it correct? Is it correct?
Yes.
Yes, sir.
Variable overhead. Variable overhead, we have what? 3,000, right? But how many
Yeah.
fixed units do we have? 1,000 units, right? So that gives us what? 3 CDs per
Three.
unit. I multiply by 700, and that gives me what? 2,100. No be so.
100.
Now, this is where you have to be very careful. Under marginal costing, do we absorb?
No.
No.
Under marginal costing, do we absorb?
No.
No, we don't absorb. So any fixed cost that you see, you can't find cost per unit because we don't absorb. A cost per unit is an absorption rate. Do you get it? That's why we took the budget and divided by budget unit. Mokai, budget over budget unit is OAR. Because marginal costing, there's nothing like OAR. It means that if fixed cost is per the fixed budget, right? The budgeted fixed cost in the fixed budget of 10,000 will be the same thing under the standard. Do you get it? Because we don't absorb, it's the same thing for standard because we don't absorb. Makes sense? Marginal costing, we don't what?
Absorb.
Absorb. So whatever you have for the fixed budget as fixed cost is the same thing that you replicate under the standard. Makes sense? But
Yes.
if we were doing
Yes.
absorption costing, do we absorb?
Yes.
So
Yes.
under absorption costing, you will need an OAR. And our OAR is simply what? Our budgeted what? Fixed costs over our budgeted what? Produced, right? Yeah. So our budgeted fixed cost was what? 10,000. And the budgeted unit was what? 1,000. That gave us 10 CD per unit. This 10 CD, we will multiply by the 700 actual units. That means we'll end up getting what? 7,000. You get it? Do you get it?
Yes, sir.
But under marginal costing, the flex will still be how much? The flex will still
10,000.
be how much? The same 10,000 under the fixed budget. Make sense?
Yes.
Yeah, so that is it. Makes sense. So this is the only thing that I want you to keep in mind. So now that we have been able to do everything, we already know the variance. So I don't like to bring the fixed budget. However, you could have brought it still. You say fixed budget, and I draw a line in here. Then I say my flexed budget, and then my actual. Okay, and then I have what? My variance. Okay, because they say control purpose, a variance must come. So how many units do I have for this guy? How many units do I have for this guy? All of them. List the units that we have.
All 700.
No, fixed budget, we had 1,000 units. Flex, we had 700 units. And actual, we had what? 700 units as well. So 700 and 700 we can compare, right? But 1,000 is out of skets. So sales, this guy was 30,000, no be so? But this guy
Yes.
is now what? Because the sales, we have 30 CD per unit. So 30 by 700, that's 21,000, no be so? Then actually, we sold 21,200. Okay. So we were expecting to sell 21,000, but we sold 21,200. Yenya mfaso na yaboka.
Nyamvaso.
Yenya mfaso. Do you get it? If you get a profit or you reduce cost, you have a favorable variance. That's what it means. Yenya mfaso, because we sold more than expected. This flex is like you expected. You get it? Makes sense. So we expected to sell 21, but we did sell 21,200. So we got a profit of 200, favorable, right? It's an addition. Makes sense?
Yes.
Yes, sir.
Clear, right? Okay, so let's go to variable cost. Material, yeah, 10 CD per unit, Mokai.
Yeah.
Okay, so this one, it was 1,000 units. We already have it on our statement as what? 10,000, obviously. So fixed budget. In exam, don't worry yourself with the fixed side. Just do flex and actual because it can waste time. You get it, especially if it's very long. So 10 by 700, that gives us 7,000 also. And then actually, what's the direct material cost? 6,600. Okay. So we expected to spend 7,000, but we ended up spending 6,600. Yenyam faswa na yaboka.
Nyamvaso.
Aye,
That's all.
400, right? Favorable. Not be so. Okay, let's go to labor. Labor, it was 5,000 over 1,000, meaning 5 CD per unit. Mewa. So that 5 CD per unit, this one was 5,000, but this one 5,700, that's 2,100. Mewa. But it was actually, we actually spent what, 3,800 for labor. So we expected to spend 2,100, but we ended up spending 3,800. Yaboka ne nyamfaso.
Yaboka.
Yaboka. We spend more than expected. When you spend, you have lost, right? You have lost more money. So how much did we overspend?
200.
We overspent 200.
Hey, no.
1,700.
No, we were expecting to spend 2,100.
8,500.
We were expecting to spend 2,100, but we ended up spending 3,800. The
1,700.
difference. It's just difference. Variance. Standard actual. The difference. Find the difference. Just say 2,100 minus this. That's all.
So I think that the 2 one should be 3,500 rather.
3,500. Yeah.
Where is 3,500?
The
5
flex.
by the flex.
Ah,
The
For the
fine.
labor.
Sorry.
Yeah.
So this should be 3,500, right? Okay.
Yeah.
Yeah.
So we expected to spend 3,500, but we ended up spending 3,800. Yaboka
Mhm.
ni
Yeah.
nyamba so.
Yaboka,
Yaboka say
Aboka.
300.
Yaboka 300, meaning that it's a minus 300, right? Let me just put it there. But the adverse represents the minus. Okay, so I can just clean it. Okay. Okay, so what about variable overhead? This was 3,000 fixed, right? So
Yeah.
when we check 3,000, that means it was 3 cities. So 3,721.
Yeah.
So 21. This one, how much was it actually? 22. So we expected to spend what? 21, but we spent 22. We have lost the game by 100 adverse. No be so. Now,
Yes.
when I put all this together, right, I can get my contribution. Okay, that means subtract all this from my sales, straightforward. Because of time. Just remember. How much do we have? This one, the contribution is 12,000. 21 minus all this, what do we get? And this one is 1,800. A loss. What do we get? 21,000 minus all this, what do you get?
Say come again.
8400.
Remember, contribution is sales minus all variable costs.
8400. Minus
8400.
8400.
negative. Into bracket.
You said it's 8,400 negative.
Yeah.
No,
Is that what you are saying?
it's positive.
Okay. So now we come to fixed costs, right? Because you are doing marginal costing under fixed cost. This one, the fixed cost was 10,000. No be so. We repeat the same fixed cost here as what? 10,000. No be so. But here was 10,400. So let's see. I expected to spend 10,000 for fixed costs, but I ended up spending 10,400. Menya mfaso anamaboka. Menya mfaso anamaboka
Aboka.
by 400
Yaboka.
adverse. No be so. Good. So this one, if I take out my fixed costs, it means that I get my net profit to be what? This one is 2,000. Also positive, but this one is what? 1,600 adverse. No be so.
That's it.
And this one is what? 1,800 adverse. No be so.
Very so.
So literally you are done here, right? This is all. This is all there is to this. But then I want to teach you one last thing before we close, which is reconciliation of profits. So anytime you want to reconcile profit, right? So reconciliation of actual versus budgeted profit. If you are lucky, this diet, you get this. But this one is a time waste. I can waste a lot of time. So what you have to do is that all you have to do is take your budgeted profit, okay? And this budgeted profit, per what we are doing, we use our new budgeted, right? Our new budgeted is the one we have calculated, which is what? Which is the standard, right? That's our new budget. Mokai, you get the standard is our new budget we are using. True or false?
That's true.
So add all favorable variances. So your variances, favorable, then adverse, right? So if you take sales, right? If it's favorable, you bring it here. If you take maybe material, if it's adverse, you bring it here. Labor and overhead, maybe you bring it here, right? When you finish, you sum up all your variances, okay? So the sum of all the variances will come here, and then you come and get your actual profit. So all you have to do is add all adverse variances and less or add all favorable variances and less all adverse variances. But if you start with actual profit, it's the other way around. So looking at this question, let's reconcile the profit and see if we'll get it correct. Did you get a whole idea?
Mhm.
Did you get the whole idea? So just take your budgeted profit, add all favorable variances and less all adverse variances, you get the actual profit. If you have the actual profit and you want budgeted profit, add all adverse variances and less all favorable variances. It's the other way around. So here, let's come here. Budgeted profit, our new budget is a fixed, we won't use it. So our new budget is 1.6. Meboa. True or false?
Yeah.
That's like our standard profit. It was 1,600. No be so. So let's bring favorable and adverse. Okay, so okay, so sales variance. How much? The sales variance. How much was it? Was it favorable or adverse?
Favorable 200.
200. So we have plus 200 here. Meboa. The material variance. We had what?
Plus 400.
Plus 400. Also favorable. Labor variance. We had what?
Minus 300 adverse.
Minus 300. Okay. Then variable overhead variance was a minus, but I don't remember. Minus what? Minus 100, right? No, be so. Then fixed overhead variance. Was it also a minus?
I think minus 400.
400. Okay, so when we put it together, our variances here amount to 600 positive, and this amounts to 800 negative. Meboa. So 600 minus 800, that's negative 200. No, be so.
Yeah.
True or false? And our budgeted profits we had was what? Actually what? From our statement was negative 1.6. Or so negative 1.6 against negative 200. Our actual profit should give us what? Negative what? Negative what?
1.8.
On the face of the account, is it true that our actual profit was 1.8? Was it true?
Yes.
Yeah.
This is how we reconcile budgeted and actual profit. So we are done for the day. We didn't learn anything today, but it's worth it. So the starting point of variance is here. Okay. Put away as here, you will understand every other variance that will be thrown to you. All right. So that brings us to the end of our session. May the Lord be with you.
Amen.
I believe
Thank you very much.
everything I taught you understood. I don't want to
Yes.
rush. Though
Yes,
you guys are reciters, I have to still take my time. But one thing you must understand is my approach is completely different. Okay. I take things from a different point of view. All right. So if you don't understand anything, let me know. All right. Good night.
Same to you. God bless you.
Amen.
Wow.